Hello, everyone. This is Jean-Marc calling from Funding Gates, and what we're going to cover today is your cash conversion cycle and what the impact is on your cash flows by reducing your cash conversion cycle. So basically, the cash conversion cycle is the most important indicator of a company's operating efficiency and liquidity, and it's essentially the time from the moment when you pay your suppliers, right, for products, goods that you purchase from them, to the time when you're getting paid from your customers, right? So if you look at this visually here, graphically, you buy inventory from your suppliers, then you pay for it, right? And then you manufacture, make a product, etc. You sell it, and then you get paid from your customers. So the time from when you pay for the products from your suppliers to the time when you're getting paid from your customers, that's the cash cycle, right? Cash out, cash in. That's the cash cycle. And it basically consists of your days inventory outstanding, your DIO, right? From the moment when you buy inventory to the moment when you sell it. Your days sales outstanding, which is the time from when you sell the product to the time you get paid. And your days payable outstanding, which is the time you buy the products to the time you pay for it. So basically the cash conversion cycle, right, to get this green area here is simply taking your days inventory outstanding, adding your days sales outstanding, and subtracting your days payable outstanding. And that's the formula for cash conversion cycle. Taking your days inventory outstanding, adding your days sales outstanding, and subtracting your days payable outstanding. And the formula for each of those is basically, for your days inventory outstanding, is you take your average inventory, divide it by your cost of goods sold per day. DSO is calculated as average accounts receivables divided by credit sales per day, and days payable outstanding is calculated as your average accounts payable divided by cost of goods sold per day. So when you calculate your DSO, the first thing you need to look at is, how do you calculate credit sales, right? And it's not all of your sales are credit sales. Some of them are credit card processed, others are invoices, right? So you want to look at the credit sales, which are sales made on credit to customers. And that's basically taking on your income statement, taking your gross sales, subtracting your sales in cash, subtracting sales returns, subtracting sales allowances. And that gives you your credit sales. Now, let's take a look at a quarterly cash conversion cycle calculation example, right? So we have our income statement data, January, February, March, and we have our balance sheet data, January, February, March. So basically, to calculate our DSO, we take our average accounts receivables for the quarter, right? So which are these numbers here, the average of those three numbers. And we're dividing it by the credit sales for that period, right? So basically taking the average credit sales over here for that period, and then dividing it by the number of days in that period, right? Which is 91 days, okay? So basically that's our DSO. It turns out to be 65 days, okay? If you look at our average inventory, dividing that by cost of goods sold per day, so average inventory is over here, the average inventory, okay? Taking the average of those three numbers, dividing it by cost of goods sold, the average of those three numbers divided by 91 days, because it's for the quarter. And that number turns out to be 43. And then days payable outstanding, we take our average accounts payable, right, which is over here, average accounts payable, and then dividing it by cost of goods sold per day, average. So that is these three numbers averaged out, divided by 91 days, because there are 91 days in the quarter. And that turns out to be 56. So if you're adding 43 plus 65 minus 56, that gives you a cash conversion cycle of 51 days. Now, what is the impact of reducing each of the components of your cash conversion cycle? So we have our original numbers over here that we just calculated, right? And let's say, for example, we're able to reduce our day sales outstanding from 65 days to 25 days, right? So the original accounts receivables was this amount, right? The average for the quarter. Now, if we're now just rearranging the formula to calculate what the new receivables volume is, right, we simply take our credit sales multiplied by our new DSO, which is 25, and divided by 91 days. And that's our new receivables volume, right? And so basically, the inventory stayed the same. Payables volume, it improved, right? Because you were able to increase your days payable outstanding by a couple of days, right? So rearranging your payables formula like such, where you take your cost of goods sold multiplied by your new days payable outstanding divided by 91 days, that gives you your new payables volume, right? So now, if you're looking at the net working capital, which is taking your inventory, adding your receivables volume, subtracting your payables, that's 79,000. Whereas before, it was inventory plus receivables minus payables is 440,000. So you basically reduced your working capital from 440,000 to 79,000 or 360,000, which is basically straight to the bottom line increase in cash flows. So it's really important that you track the cash conversion cycle on a regular basis, either weekly or monthly, so that you can spot all of the trends and of the different components of your cash conversion cycle. How your DSO is changing over time, how your days payable outstanding is changing over time, and how your days inventory outstanding is changing over time, right? And then ultimately your cash conversion cycle. If you see it increase, it's not good, right? And you can see why. It's because your day sales outstanding went up significantly, right? So you can see that by reducing your day sales outstanding and getting paid faster, right, managing receivables more effectively, more efficiently, etc., and reducing day sales outstanding has a significant impact on your cash flows, straight to the bottom line. So you don't need to get financing or a bank loan, etc. It's simply by managing your receivables more effectively day to day to reduce your day sales outstanding, and you will see a direct impact on your cash flows. That's it for today, and I hope to see you soon.